you back if you're still around. So this is not the first disruption in the model world, right? We had a Great Depression, 2 world wars, and of course the global financial crisis, where we saw private equity multiples in some industry snap back quickly. In other, it took up to 10 years, and in some, they have still not recovered. In other words, their P multiples have been re-rated downward for good. Will the same dynamics unfold in the recovery from this pandemic, or will this time be different?
Again, yeah, there has been no crisis in private equity, so it's not comparable to World War or 2008. There's no problem for this industry. So again, except if you are loaded in energy and the like. So so I don't think it is, yeah, it is any sort of drama. But people might get upset at the fact that the government have rescued a lot of these investments that are highly levered. There would be I'd be happy to give a talk at another time on how to distinguish cowboys in the industry. I have plenty to say about that. Yeah, no, so I think this crisis would have very little effect. The trends will continue. There will be more and more funds focusing on impact investing. There will be more and more talks about ESG, like just the trends that were there before the pandemic will just continue as if nothing happened.
And so we are now at exactly 1 year into the pandemic, and analysts are still undecided about the shape of the recovery curve. You know, K, U, V, W. I think I've seen almost all letters of the alphabet passing by. Well, first of all, for the students on the call and also, you know, non-private equity experts, why are there so many discussion about it? Why is it important to know which curve is it going to be, and what is your idea on the potential shape of economic recovery?
Well, so if anything, yeah, it's the letter K, I guess, because you have some people did extremely well. Again, everybody in tech related. And people who didn't do well are, you know, again, leisure and energy. So, but for the people in energy, I guess they will not really recoup from it. But the ones in leisure, for example, yeah, what I would expect is once these restrictions will be lifted, people will go even more to restaurants than before. So there will be a slight recovery there. And given that, you know, the government picked up the bill partially, fully, depending on the countries, for during the pandemic, so these guys will do well. But you have all the people that you know have done well throughout the crisis, and it's a very large number of people. We should not forget that.
Greg and Mark, I invite you to join, and for everyone just to keep their camera on. Do you share this view, and also for which type of economic recovery are you preparing your investment activity and portfolio companies? Whomever wants to go first.
Yeah, thanks. I'll go first. I mean, we're being more selective, I think, in our co-invest portfolio for the most part, and even our secondary portfolio. We view those as more opportunistic in nature, where we can actually choose where we want to add our exposure. On the fund side, obviously, you need to pick the best managers who can hopefully perform in all cycles. Historically, and it's hard to go back and forth, go out, leave a manager and come back. So we try to pick managers there that we can consistently back or hope to back. But on the secondary and co-investment side, you know, with the prices we have to pay today, we're being very careful that we back resilient business models, and we're probably seeing a flight to quality. So we'd rather pay up for a quality business than try and, you know, find value or turnaround in this market. So I would say we're upping our quality game when it comes to buying secondary stakes. And the co-investment side, you know, focusing only on quality. We turn down about 75% of the co-investments we see, and even though I think our purchase prices are increasing a little bit, we're happier with the portfolio and the resiliency of the portfolio and paying up than we are looking for value in this kind of market.
Yes, well, it's equally, it's more a bottom-up approach, looking at the opportunity by opportunity, but particularly as the majority of our program is in fund investment, to us is to get a good understanding what's the value creation plan of a manager, and is that sustainable for the foreseeable future. If it's only a leverage game, but I think those days are way behind us. If it's only a leverage game, then it's definitely a no-go with the current high price environment. You need to have managers that are able to create more value and that underwrite their deals with a contracting multiple rather than a expanding multiple. That's important to us, but it's a bottom-up approach.
So another question to you both, Greg and Mark. So according to Perkin today, private equity firms have about 5.5 trillion of euros assets under management, and the industry sits on roughly 1.5 trillion of dry powder. And private equity funds could very well start deploying the distressed and other opportunistic assets, starting from now. Are there any signs of economic recovery? Are you seeing the M&A activity resuming, or are we not out of the woods yet?
I think we're seeing quite a big increase in activity. M&A, add-on acquisitions, the volume of co-investments we're seeing all point to activity kind of back on the kind of straight line we saw before the pandemic. And I would say, even though the amount of dry powder seems to be increasing, our funds that are coming back to market much faster than we expect. So we're actually seeing more capital calls, more frequent capital calls, and the fund cycles shorten. So even though GPs have usually 6 years to invest the capital, I mean, 90% of our portfolio is raising new capital within 3 years, even as the fund sizes are increasing. So we're not seeing a deployment issue yet. It can cause a concern for us as more and more of our portfolio has been deployed at higher prices. So we've got that concern, obviously. You know, if rates and easy money go away, that's going to really affect valuations. That's where we're hoping companies will be able to grow out of that issue with a longer hold period if they have to. But we're not seeing a slowdown in deployment at all.
No, perhaps a remark with regard to the dry powder. So yeah, you do see a lot of statistics, and it's always on top of mind of institutional investors. A lot of people worry about it. But personally, I think the wall of dry powder is much bigger. And to give you an example, yesterday we had an update call with one of our managers. They're working on a new investment. It's an equity ticket of 4 billion. They are willing to invest about 600 million, and the rest was syndicated, and it took them less than 6 weeks. So that does show you how much money is available from institutional investors. Do you worry about it? Yes, of course. But you can also look at it from the positive side. This is a safety cushion. That means that valuations won't drop dramatically due to the fact there's so much dry powder available for these investments.